Welcome to another video of financial indicators, video number 17, that talks about a very significant subject that a lot of investors use on a daily basis to evaluate companies. This is what we call credit rating. What it is, it's actually a given rating to assess the credit worthiness of an entity, whether it be a corporation, a government, or a financial instrument like bonds. Of course, it helps investors understand the risk associated with lending money or investing in that entity. A higher credit rating indicates, of course, lower risk and a higher credit worthiness, while a lower credit rating indicate higher risk. Credit rating, of course, are calculated by credit rating agencies like Standard & Poor's, S&P, Moody's, and Fitch. Each agency has its own specific scale. For example, S&P scale range from AAA to the highest credit quality to D, which is the default. Of course, companies with a strong credit rating may find it easier to raise capital or enter into a new market or negotiate even a better term on a contract with suppliers and customers. So let's dive now into that subject to understand it better. Calculation of the credit rating. Credit rating, of course, provided by trading economics, to use, on a daily basis. What we use, what kind of factors? First, we go with the financial statement, which assesses liquidity of that company or entity, profitability, and overall financial health. And then we use debt level, which evaluate current debt load and ability to service those debt by that entity. And then we go with economic environment, considering, of course, broader economic condition that might affect the entity ability to meet its obligation. And lastly, it's management quality, reviewing the management team history and strategic plans for that company. Then that will give us an overview of that entity, whomever that entity is. Could be a country, organization, or a company. Now let's see how credit rating is used. For what purpose is it used? Of course, we know it has a purpose, the credit rating. First of all, we use it as an investment decision. Investors use credit rating to determine the risk level of investing in bonds, for example, or other debt security or asset. Higher rated bonds are considered safer but offer, of course, lower yield, while lower rated bond might offer higher yield but come with more risk. Also, again, we can use it for loan approval. Financial institutions usually use credit rating to evaluate the risk of lending to a business or a government. A higher credit rating generally means the borrower can secure loans at lower interest rate. And also we use it for business decision. Companies might use credit rating to assess the risk of doing business with other company or government. For example, supplier might check the credit rating of a potential buyer before agreeing to a large contract. Now, let's see the credit rating, how it is really categorized. Credit rating, of course, provided by trading economics. It's used to assess the credit worthiness of country with higher number, of course, indicate lower risk and higher credit quality. The AAA, which is AAA, consider prime, correspond to the safest rating. And if it is between 50 to 40, which correspond to BB plus to BB minus, that's considered non-investment grade, speculative. And then if it is between 20 to 0, reflects substantial risk, of course, with 0 indicate default. So you can see the rating here: 100 AAA prime grade, between 50 and 40 non-investment grade, which is speculative, of course, from 20 to 0 substantial risk, 0 consider a default on loans or whatever, or on obligation. Let's see the scale of it. How is it done? Of course, as I said earlier, credit rating is done by 3 companies: Moody, S&P, and Fitch. But the categorization, mostly all of them, they fall into the same one. And of course, here you have the description, and this grade and this high yield, of course, for high risk junk. As you can see, triple, high grade, low risk, which is the AAA. Let's just focus, for example, on the Moody. AAA, can see AAA, it's high grade, low risk, highest grade quality, minimum credit risk. If it is a AA, that's considered very high credit quality, but very low credit risk. Okay, also AA. Okay, now 1A, consider high credit quality but low credit risk. Okay, that consider upper medium grade. So it's categorized into high grade, low risk, then upper medium grade, and then lower medium grade, like the AAA, triple Bs, good credit quality, moderate credit risk. Then we come to the red zone, which is a speculative higher risk, BA at Moody or BB. Issuer faces adverse condition and uncertainty, substantial credit risk. And then if you have just 1B, that's highly speculative, high credit risk. Issuer able to meet financial commitment. But if it is now, we go to substantial risk, anything C, double C, triple C, vulnerable and default likely. And of course, when you come to the worst, which is the D, that's a default. Lower rating, issuer in default, and Moody doesn't rate it, but S&P rated as D and Fitch rated as an R&D. This is actually, you can use it as a reference to evaluate the company and then see where they fall, which category. Are they in a high risk, upper medium, high grade, low risk, upper medium or lower medium, speculative or default. And from there you can evaluate the person you want to deal with or do business with or give a loan to. Okay, now let's have a comparison between the high credit rating versus the low credit rating and how it affects some aspects. Let's go first for the bond. What's going to happen to the bond? Of course, the bond price will be high, but will be lowly yield here. Okay, but they are considered safe, so bond prices will go down, because when you have a high credit rating, your bond prices will be lower, because you don't need to issue bonds to cover up some issues that you need money. Therefore the bond prices will be lower, will be low yield. They're not like something people would want to buy at that moment, so their prices will be falling. Okay, now with the stock prices, of course, you have a high credit rating, stock prices eventually will be also high, that's automatic. How about the loans, interest rate? Of course, when you have high credit rating, that's a big positive, so you will end up with getting a low interest rate. Okay, and when you have, of course, the high credit rating, you will end up having large contract, so the large contracts will be going up, and the confidence will be, of course, going up for high credit rating, eventually. Now, when you have a low credit rating, what's going to happen to the bond? Of course, at that point you need to issue bonds, in order to, make up for, you are not having cash. So the bond prices here will go up and the yield will go up. But remember, the bond prices of the new bond, the yield will be high, because you are trying to attract investors. But the older bond their prices will go down. But here the bond price will be low because you're trying to attract investors to buy your bond, and you try to can seduce them by giving them higher yield. So the bond prices will go up. Now, what about the stock? Of course, lower credit rating, your stock price will fall because it's increased now, what we call it risk and vulnerability. So your stock will go down. Of course, with interest rate, you have a low credit rating, your interest rate will be high, so the interest rate will go up. Of course, the confidence here with low credit rating eventually will go down, so the investor confidence will go down. Here, this is some chart just to give you an idea the credit rating impact on bond yield and stock prices, and you can see bond, stock prices, and how they interact according to the rating, according to the rating, bond yield, stock prices, and you can see AAA, AA, 1A, BBB, etc., etc. And also here you have some visualization. When you have a high investment, the high, you call it investment grade, that's AAA, AA, also risk level arbitrary, of course, scale. Medium investment grade, the A, BBB, low low and very low, which is near default. So I hope this gives you an idea how to use the credit rating in evaluating your partner in business and be able to understand their credit worthiness. See you in the next video.